So I guess good afternoon to everybody, lunchtime on a Sunday, and I actually prefer no other way to spend a Sunday than doing this. I guess for 20 years I've come through finance to get to today, which is kind of always a journey in life. So I guess for me, how and why I was here, it started with a cup of tea on a lawn in a hotel in Zurich a number of years ago, where through the formation of the Blockchain Association of Ireland, I got to meet Richard Olson through a mutual colleague, Alan Lausch, at the time, who introduced me via a colleague of mine in London. And I was fortunate enough to support the Liquor project for a short period, and a contribution that actually drove what I will talk to you today about, which is disruption of the insurance industry, and why I believe the insurance industry needs a refresh or a reboot. So not many people quite appreciate, but the role of insurance in society, both from an individual and a commercial standpoint, is quite large. In fact, you're looking at sort of 10% of GDP is the collection of premium around the world. So if you think about $10 trillion of premium flow, that creates a lot of assets and a lot of diverse type of investment products. So the goal of any insurer is to collect more premium than they pay out in claims. But as we move to a new world, emerging risks are quite difficult to predict. And in my field, we always look back in the past and take a picture, whereas what I'm trying to do is create more of a film process so that we can understand today what the future may look like so that we can finance that. So I'll give you a short overview, a sort of historical perspective of insurance. It's not something that's happened overnight. We've looked at sort of 8,000 years of evolution. And actually, if you ask me professionally and personally, I don't think we've actually progressed very much. So I'm hoping the next iteration of insurance, we develop at a very fast pace. I'll give you some facts and figures, particularly for many that may not know how the global insurance market is constructed. It might be useful for you. My goal is to pass on knowledge so that participants can be inspired to look at insurance. And for those that want to disrupt a very big industry, you're looking at sort of trillions and trillions of dollars of perspective. So that perspective starts with historically. If you go back sort of 6,000 BC, that's 8,000 years ago, you had what they call bottomry loans, which is essentially merchants back in the Babylonian times sending goods back and forward across ships. If they suffered an impact in a storm and had to get the ship fixed to bring the goods back, they were giving effectively a loan. And in today's modern world, it's a product that's taken, I guess, more interest in this kind of concept of catastrophe risk, which basically means if the ship didn't come back, the financier lost his money. If the ship came back safely with the cargo, they would get their money back, plus a share of the profits of the merchandise that they brought back. So that sort of evolved then into the Roman times, which is what they called benevolent societies, which was more of a mutual risk. So if you were a Roman soldier and you were injured or your family needed taken care of, you would be financed. So I think that's sort of more of a reward mechanism back in those days. So human progress, insurance, they're all interlinked. It's very technical, very statistical, very mathematical. If you look at the genesis of insurance and maths, or maths and insurance, in today's technology world, it's just an evolution of that, if you ask my opinion. But I think today, it's kind of lost its way. So the modern day insurance world, if we move on, I guess maybe to sort of mid-1600s, you had what they call in the London city, Lloyd's of London, which is a sort of modern day insurance practice, if you like. And it was quite simply individuals meeting in a coffee shop in the city to discuss merchant trade. So again, shipping goods across the globe and global trade. Around, I think, like 1666, there was a fire in the city of London because the buildings at those times were very wooden, well, all wooden actually. And there was a bakery, a small bakery in the middle of London that had a fire. And that fire spread throughout the city. That was a very important time in history where we had what we call the Enlightenment period, where there were very eclectic individuals challenging, I guess, societal values, mathematical values, and try to move people into a new way of thinking. To mark the drive of insurance in the modern world, Sir Christopher Wren, who was a founder of the Royal Society of London, built a telescope in the site of where the Great Fire of London broke out. So if anybody is in London, I would encourage you to visit the monument. It's very close to London Bridge, which is on the cusp of the City of London. And actually the telescope doubled up as a telescope. The monument doubled up as a telescope because at that time there was a very open thinking about trying to understand the very world we live in, but also outside our world. So I think 300 or so years later, my view is we're living in that period now, and we should all make the best of it. So we move on then to talk to the point around data transfer. So insurance is data heavy. You need accurate data, and what you find is you start very much with a whole collection of data as funnel effect. And that moves from, I guess in the future, from a lot of third parties or automation through the Internet of Things. And as everybody digitizes, we're collecting more and more data every day. We've got too much data, in fact. And so what insurance does is it tries to make sense of this data, correlations, in order to price the underlying risk. So these are sort of personal data. So for example, you have a bicycle, you know the value of the bicycle, you know if you fall off or not the bicycle. So as an insurer, if you collect premium and the individual doesn't fall off, you make a profit. But if the individual falls off and has a large loss beyond the premium you collect, you have to somehow protect that. So the information moves through the channel. So you have your insurers at the front end, but typically, if you look at a frequency curve, this is really sort of the big, I guess, bucket in the middle that has, 99% of the chance of happening, but a very low financial impact. When we talk about disintermediation, you have what we call agents and brokers. And they operate at many different levels to price the risk, service the client, and then also push the risk up to another layer in the insurance marketplace, and then beyond into the reinsurance marketplace. And there's actually a couple of other layers which I'll talk about specifically at this talk in the sort of blended finance level. So when we look at the colors here, these are a bunch of colors, bunch of different risks. But as you can see, they gradually begin to morph into sort of very predefined structures. And as we move on beyond this, it becomes more like synthetic debt. So for me as a practitioner, I always follow this type of information, because what it indicates to me over time is the amount of capital that's within our market. So as you can see here, it's quite healthy, $625 billion of capital. So what that means is an insurer has this as a bank account to start trading off of. But what's interesting to me is this line here, which represents alternative risk capital. And what that means is it's a more of a financial market-led, or the bottom-line loan, as I referenced before, that type of product that the markets have to actually cover the very, very high-end catastrophe risks. So if you imagine, Hurricane Katrina, the World Trade Centers, the tsunamis in Japan, and I'll show you some slides after about how these products are actually stabilizing the underlying sort of consumer and the underlying businesses. As I said before, insurance is very important. You need to get the capital quickly back into the business, back into the country, back into the local governments, or back into the consumer to get them back working for the economy. And as I said before, 10% of GDP is insurance premium, and I think there's around about $40 trillion of assets supporting that premium flow. This slide is always interesting to me to follow over time, because what this represents is just I guess the frequency between man-made disasters. We think of the tragic World Trade Center events, and natural catastrophes, which are sort of, I guess, climate change events. And as you can see here on the top line is the number of natural catastrophes is now outpacing the man-made. So there's probably a whole bunch of theories of why that is. Is it the period that we're living in of climate change? It has very big dramatic impacts. I'll also talk to you about the protection gap that we're trying to fill. I also think risk management has got better from this period really onwards. So you can see the man-made disasters are lowering, but the natural ones are tracking up. I'll explain why I think that's important. What we've got here then is a slide that, I guess, incurred losses versus uninsured losses. So what that means is not many people sometimes buy insurance. They don't feel they need it. It's a behavior aspect, or sometimes there's a legal requisition to actually buy insurance. So what interests me in this information is that the total loss, and this is probably, I'd say, the hurricanes and the Japanese tsunami maybe, that the insured economic loss, that's insurance plus the economic loss here, is really, really high. But the insurers are really picking up the blue line here. So as you can see, the rolling averages are gradually getting up. But you can see now, actually, the insured losses are quite high statistically over this period. So what that basically means is somebody's, as an insurance practitioner, an accountant at a dinner party, I'm not the best conversation if I'm talking about actuarial, but the biggest question I get is, well, okay, you work in insurance, why has my car insurance gone up? And actually, I struggle to answer that question very often, because I know the capital is coming from very few similar participants, and by the time it gets to the consumer, there's actually very little competition between the bottom end pricing. Why is that? Because pricing is set over a 1 year, 3 year, 5 year horizon, but at the bottom layer, it's very sort of snapshot. You set the premium one day, so there's no fluidity in the mechanism, which is why I think it's broken. I've took my goal is to change that, which I'll show you some about my project after. So for me, again, other indicators when we look at these alternative risk capital is the interest rates that they can achieve. But these are all at-risk products. So for example, the bottom loan is the ship doesn't come back, you lose all of your money, but if it does come back with the merchandise, you really are in the money quite a lot. And that's why these products, as I'll show you the next slide, in comparison to interest rates, do actually have quite a high coupon level in comparison to the expected loss. And if you look in this zone here and match it back to the previous slides, you'll see actually the influx of capital is where there's no capital in the traditional market, so the participants look to the alternative market. And when you look at low interest rate yields, insurance products are quite popular because they double up the return, if you like. There's a higher risk, but you get a diversified asset by participating in insurance risk, but yet the assets are actually invested in underlying traditional risk. So you sort of enhance the yield by using insurance techniques, which actually works in the favor of the insurer because they're trying to recapture the losses they've made. And as we see more natural catastrophes, the increase of these type of products is growing. I think they're a very effective mechanism, personally. So again, just to put some perspective, to a 10-year US Treasury, so that's a longer term outlook than, say, an annualized bond. But you can see the interest rates are declining, which is correlating then from the previous slide where these new products are growing. So if we go back, sorry, too far? You can see these interest rates are very high, but they're very risky. Like I say, they're all risk type of products. So I guess for me, as a chartered accountant, finance, capital planning, I've worked my career trying to make sense of complex products to explain to board of managements to make decisions. I think alternative risk transfer is, as they say, part art and part science. And that's because actually there's a lot of science statistically, but we still have a very human behavior with insurance, whether we decide to buy insurance or not, how risk-taking or averse we are. So I'd like to touch upon that in my next couple of slides. So it's a short video a friend of mine created, if it starts to play. I guess if it doesn't start, it's the, as everybody may be familiar with, it's the fable of the six blind men and the elephant that approached the elephant at different parts. And it's only when they reveal them their blindfolds that they get a sense of the truth. And I think that's true for risk management. And it's true for the work I do with a lot of Fortune 500 companies, that when you talk to legal or you talk to human resources or finance or compliance or treasury, everybody has a different view of risk. And what that means is when you're designing a global insurance program, to get this commonality amongst everybody can be quite challenging. You have a lot of sort of group behavior and culture of an organization, and you have actually the underlying organizations or the industry they're in. So some industries are more conservative than others. So you start looking at the tech industry, they have a very different profile than, say, an oil and gas or an aviation sector or the banking sector. So what I find quite interesting is the enterprise risk management definitions, and actually then the practical applications of enterprise risk management. And then I'll take you through some of the work I do with Fortune 500s, why that's important, because over the last 20 years, I feel there's an evolution that's needed in the private insurance market, the personal insurance market, by deploying the same risk finance techniques as corporate multinationals who've been using some of the products that I work on, niche products or financing products. Now they're becoming more available. So I guess I won't read the definition of the enterprise risk management. I think it's a challenging topic to condense, and it starts you off on a sort of journey of sort of retain risk or take risk. Or some people, I guess, can be quite lazy and just say, well, yeah, hey, I'll buy insurance. And actually that's probably one of the most dangerous attitudes to take. So what I'd like to talk to you about in this particular slide is actually the work I do with Fortune 500. So what we're looking at, any typical corporate spends about 1% of revenue on insurance costs. So if you're a multi-billion-dollar revenue company, you're spending quite a lot of money on insurance. But when I talk to CFOs and CEOs and treasurers, they don't really pay attention to the cost of insurance because it generally takes a relative sort of ebb and flow. It's a 1% line item. But when I start to talk to them about their bottom line, so if we took a simple example where you have a 10% earning company, the 1% and 10% all of a sudden is quite a meaningful number. So if you can shave efficiencies out of the 1%, it has a magnified effect on the earnings per share, which is a perpetual kind of a benefit over time. But what you also find by focusing on that, you get a greater attention to risk management once you start putting real numbers. And I'll explain to you later on in the slide about some of the techniques that I use called captive insurance. And it's a sort of new, in the last 20 years, popular risk financing technique. So the insurance market works in cycles. We call the cycles hard and soft markets. And what that means is a soft market, there's an abundance of capital in the macro level. So the pricing is very favorable to the insured. So a soft market will be, in times where there's less catastrophes. So what we're entering right now in the last year or two is a hard market cycle. So Fortune 500s try to look at the cycle of the external insurance markets to try and smooth over the volatility in the pricing that I explained to you. So a hard market dynamic means actually there's sort of less capital in the marketplace. So the slide I showed you before, you can see an increase in natural catastrophe events and this phenomenon that we're calling sort of interconnected storms or secondary perils. So you may have an earthquake that leads to a flood, so you've got a sort of a double up of the economic loss. So there's not so much capital immediately available, so the pricing naturally increases. And when that happens, when that happens, then the risk management aspect is the corporate on the other side of the world that is not linked to that particular catastrophe suddenly has to get a share of the cost of the increase in the premium. So CFOs don't like the volatility. So once they see the price of insurance going up, we work with them to try to bring that down over the long term. And we set these things up called captive insurance companies, which are essentially, if you imagine a manufacturer, it sets up its own regulated insurance company, capitalized and regulated by a central bank in a domicile that's favorable to a global multinational. 90% of Fortune 500 companies have these vehicles. Throughout my career, I've been fortunate enough to work with most, if not all of them, and looking at actually how they use this capital vehicle. So I've been very lucky in my career. I had no desire to enter into insurance as an accountant. I just happened to get my very first job in the Hertz car rental company, where they were one of the first in the world to set up their own internal insurance company, which at the time they were owned by Ford. So there are about now 6,000 of these regulated self-insurance vehicles, and they form a very valuable piece within the value chain of insurance, particularly as we try to predict out, which is not easy, emerging risks. One of the topics I'm working on at the moment is carbon credit, carbon emission risk management. So captives are embedded in the enterprise risk management framework. It's good enough to understand your risk, health and safety, people protection, asset protection, investor protection. And they act as a very good mechanism to actually bypass the lower level of the insurance market and get you into the level that actually adds the true value to you, which is if you have a serious loss. So when we talk about risk finance decision making, then I generally start the process by interviewing. So there's an awful lot of risk management information, risk registers, and we're talking here about global multinationals, so companies that operate in every country in the world. It's very fragmented. So we try to make sense for a board of management where to direct their energy. So there's an awful lot of good work that's done. And that sort of starts then with risk appetite and behavior. So some board of directors or board of management are quite risk-taking by nature, or some are quite risk-averse. We then look at the balance sheet on how much financial retention can a corporation withstand. So if you didn't buy insurance and you had a $100 million loss, well, you may be bankrupt. So they will buy insurance to the point that it protects their balance sheet. But likewise, human behavior comes in, and I've seen products where a client is paying, say, $3 or $4 million a year for a $10 million insurance policy, and I say, wow, so you've had no losses for 20 years. Why do you buy this? And he's like, well, I don't want to be the guy that didn't buy the insurance. So when you talk to individuals who are more confident about the risk-reward spectrum, you find actually they get a much more efficient program. So what we do is we then establish the total cost of insurable risk. So this is adding up every single risk on the risk register, understanding to buy or not buy insurance, and then try to put a number around it. But then we try to keep the right balance between a centralized risk management and a decentralized risk management, and the complexity of risk financing across borders. So insurance is a very good mechanism when you have to recapitalize a subsidiary that you don't want to put a lot of capital in for various reasons. But by doing that, you either operate a centralized risk management framework or a decentralized risk management framework. I don't have a view on which is good or bad, but what you find is organizations that evolve over time are generally more fragmented than the newer organizations, particularly when there's a lot of acquisition. And as I said to you, most Fortune 500 companies form their own insurance company, which is quite interesting when you talk to very proficient, groups of management, that they think by setting up an internal insurance company that suddenly the risk is off their balance sheet. But I find that quite funny as an accountant by saying, well, You've just moved the risk from one pocket to another, so it's kind of still on your balance sheet, and then they get a bit spooked out. So why am I passionate about what I'll show you towards the end of this presentation is I've no doubt blockchain technology is the future for my industry, for a number of reasons I'll explain to you, but also that when we start looking at a traditional global insurance program, and this is, I guess, a policy limit of over $2 billion in different markets around the world, you can see just basically how messy that is. You've got so many different people operating at so many different levels. So this lower level is every dollar of claim you have, so the value rises for your cover. And then across this way is you try to fill what we call in the industry like a panel. So you go out, as they say, to the market of London, and you try to find participants to take your risk. And that's a very, very manual process. So I've set myself the mission, if you like, to transform that into a fully digital experience. But I'm not starting with the corporates, but I'm deploying corporate risk finance techniques to consumers to basically give everybody in the world an insurer in their pocket, their own insurance company, their micro insurance. So alternative risk finance, this is non-traditional but still quite traditional. So as I said to you before, what we try to do is get the right frequency severity line. So anything that's, I guess, high frequency, low severity, predictable kind of risk, we shouldn't really be buying insurance from the external market. We should be managing that internally. And we do that through retentions, where a retention is if you have a claim, you pay the first dollar or first $10. So we try to get that balance, to get higher up to this value chain, because this is where the catastrophe money helps the organization get back online. So my next slide here is art. Now, I personally think that's a piece of art. They say beauty is in the eye of the beholder, so I'm not so sure what that says about myself, but my wife seems to find my attitude attractive. But to me, what is we would say a masterpiece is this level. So we're basically removing the non-added value, all the cost, all the agency fees, all of the paperwork. We're managing that ourselves across two different products. We're setting up our own insurance company, and we do. Like I say, 90% of Fortune 500 have them. But we're using them as a cloak to get through this layer, which is where it doesn't add much value to the client, but or to the buyer, because they want to offlay this level. But then there's a whole different profitable level up this way. So the macro capital, insurance-linked securities. So these vehicles are not being used so much now, but I believe they will, that you're getting blended products up here. So what you're beginning is creating this kind of very highly efficient value chain from the capital to the ground. So with that sort of 20-year slides and 5 slides, it's quite sad, but the future revolution for me is the Internet of Things, connected devices. We talk about universal basic income. I believe universal basic insurance. It should be almost like a right for individuals to access insurance. And in some emerging markets, people can't actually get access to the products, not only because they don't have a bank account, but actually they don't have identification and all the good things that these type of forums are exploring now. And I do believe firmly that removing the unadded value go between individuals, creating a product of transparency, because many may not know, but for $100 of premium, conservatively estimated, you could say 40% is paper-based cost, maybe even up to 60% is an efficiency gain in that aspect. So we are at the journey of that after 2 years, and I'd like to show you our product after I finish. And we're live on the market in a pilot sense, because we don't want to scale until we get the technology right, because blockchain technology is still evolving, and we don't want to make mistakes in a highly regulated environment. So I like these sayings, I guess. Free from ignorance, from superstition, from the arbitrary powers of the state. People talk about provocation or sovereign state nations. I think the internet's been the revolution. Blockchain is just that next step of interconnected evolution, and it's causing an upheaval. But I think the saving grace of everything is that human beings are more aware of what they're going on across the other side of the world directly with their peers. So I believe that we can build actually an interconnected financial services product and take forward what our sort of, you could say our founding fathers 300 years ago into the next step. So for me, I'm living in that moment of change, and through the blockchain technology, I actually believe we can create that new world. So taking all those things into account, our embryonic startup, which is 2 years old now at this stage, I talk about sustainability, transparency, security, data privacy, and all of those thoughts had been rolling around my head over sort of 10, 20 years to get to the point to take the leap into the unknown. And we are very pleased that we've received funding and we've got a compliant product on the market. And I really believe that we move to a digitized, democratized, and decentralized world, not without its challenges, not without the conflict, but I believe actually there will be an emergence of a better world for everybody. So I'd like to thank you for listening to my professional thoughts and experience. And I guess before I leave, I'd just like to thank Sergey. I think it's a relationship for me that I look forward to continuing. And I'm pleased to have met you through Richard, through others. So thank you. Oh, sorry, any questions, I guess? I usually just leave, so there's no any.
Thank you for this very interesting presentation. I have two questions. If blockchain technology was not available, how much of what you've shown us could you do without blockchain technology? That is the first question. The second question is that I have myself faced the situation that you describe, let us say, in a board of a small company questioning the need to ensure very low probability and low impact risks. That actually cost quite a bit to insure. But I think when there is some kind of bias in favor of buying insurance, if you are on the board or an executive, if you don't know really the risk, you can't quantify it, nobody can blame you for buying insurance, especially if it is not your money, but it's the company's money. So it's kind of the easy way out to say, I buy insurance rather than doing something else, rather than trying to mitigate the risk something else. Do you have any suggestions on how to just direct the insurance spend in the most appropriate way, in the light of this possible bias?
So thanks, Giuseppe. I think you talk about the behavioral aspect of it. I don't want to be the guy. It's easy to pay insurance premium. It's in the budget, and that's fine. It's when that insurance doesn't respond. It's the tricky gray area that you feel like you've bought insurance, but maybe actually you buy a $10 million policy, but you have a $20 million claim. You still pick up the 10. So this is the interconnectedness between risk management and risk finance. You have to set the levels in a way that avoids that situation of ignorance. Just buy, we've carried on buying. The other thing you might consider is some industries don't buy any insurance. If we look at the big oil majors, they don't buy any insurance. They only buy insurance when they have to issue a big policy like nuclear or oil exploration. So they don't see any value in insurance for the following reason. They put it into their own insurance company. But if you look at the Deepwater Horizon, the share price didn't really change much because the analysts are already pricing in that big event over the long term. They also know after the event, there's still going to be the product. There was another Swedish manufacturer of fridges. They had a big loss. It's unpredictable loss. So analysts forgive management for those type of losses. But if you had a factory that you didn't insure, there's a kind of reasonable fiduciary duty to actually buy insurance. So again, insurance isn't high on the agenda of boards. But it's when you start talking about the impact to the bottom line, particularly in a market that's volatile, the banking market was a point in case. Having good insurance or not is the difference between being in profit or loss. And so for technicians, yes, it's highly statistical, built upon hundreds of years of thoughts, but there's still a human element to it, which is take risk, avoid risk, or buy insurance. Hopefully that answers your question. Okay.
All right. Sir, thanks a lot for your presentation. My name is Artem Levin, and what's interesting, I'm actually now in the process of starting Nexus Mutual product in decentralized finance technologies. Yeah. So you talked about Hyperledger Fabric, kind of private blockchain solutions. But do you consider some products and systems like Nexus Mutual actually, or something like this in decentralized finance on public blockchains?
Yeah. So I think actually it would complete Giuseppe's question as well around if blockchain wasn't available, what would you do, right? It's the kind of the type of question. So first of all, mutualization of risk, yes. And I think last year I presented on Teambrella. I gave a shout out to Nexus Mutual. They're on the Ethereum network. Yeah, it makes sense. For me, I've took the approach, rightly or wrongly, to look at the business model first and understand how I can improve the business logic, and then find a technology that fits my idea of what the business logic is. Unfortunately, we've researched a lot of all the blockchains. This is our first step into hopefully what might be a new future, but I'm, I guess, conservative. I believe in a lot of the projects that are out there, but I'm trying to take some practical kind of steps, because I think you need a lot of capital to realize the full utopia.
Yeah, sure. And regarding metrics, I saw that only $2 million locked there, and it's kind of plate graphs there regarding locked deposits. So it's not developing now.
Yeah, well, mutual risks are, like I say, thousands of years ago, they're very popular techniques, peer-to-peer. But it's very funny about mutuals and behavior that we're all friends if we have no losses. But as humans, we're quite protective. And so it's when you have a big loss, the mutuals are really tested, unless you've got a very aligned view of interest. So I work with all sorts, and again, those type of projects I'm following, I like them. For us, it's just not the technological solution for today, for us. Yeah. So, yes.
Vladislav Rutsky. I have a question about your startup. Will you please elaborate on what are your prospects for the near future and within 5 years? And what about blockchain within 5 years in your project?
I have no idea what next week will be. But I don't know. Where I'd like to be is a different, okay, so it's like where my idea would take me is very different than the reality. So the reality is we've been working on the project for 2 years. And in reality, I've been continuing my other traditional work. But you migrate and you move. So a year ago today, I wouldn't know we would be partnering with a particular person on a particular risk and executing upon that. So tomorrow it could be different. But to me, the underlying process is what's important. So people are coming to us to put this product, put this idea, and it's like, yeah, sure. Like, doesn't really matter. So from a technology standpoint, we've done a lot of research, but we've left it in a way that we can be adaptable. So I would recommend to anybody out there looking at application development to really look at progressive web app technology, because it runs across the internet. You're not necessarily beholden to Apple or Google greenlighting you or not. And in our field where, you're trying to push the envelope to the very edge. So for me, I jump off that edge of the first side, and then there's a whole other side of the envelope to go back down. But you don't want to break the law. You want to bend it, but you don't want to break it. So for me, there's a regulatory barrier, a technical barrier. But quite simply, customers, they don't really. The market research we've done, they don't really care what the technology is. They just want to make sure that I have a policy, I have a claim, will you pay it? And then there's a whole bunch of other stuff. So in a year, if we had 100,000 bikes insured, yeah, I'd be pretty happy with that. Maybe 1 million, 2, 5, 20.
Maybe one more small question. What do you think about decentralization, the total decentralization in the insurance industry? Maybe if you find enough a bunch of investors that would like to crowd invest into this scheme, and with the help of blockchain, not only on the part of the client, but also on the part of the investor, to build a completely decentralized system.
Yeah.
The crowd insurance platform.
Yeah,
Okay.
That's it. And it's funny you should say that. I got offered quite a fair bit of money for 60% of the company. Like, why would I do that? And then the other thing is you go to an investor, and obviously as an accountant, I kind of get the idea. We buy big ideas, we back big founders, So you meet them, and I find it quite funny, actually, because there's a conflict of interest with them. And then so where's your cash flow? Where's your clients? It's like, okay, well, I thought you were backing a big idea here, not what my 12-month cash flow cycle might look like. And then you have other people that raise money, and it's like, wow, okay, so it's a passion and a belief. So our fundraising ambition is to grow a product for people outside of the institutions. But you can't be foolish, because insurers have been around a long time. They yield a lot of knowledge and information, and they yield a lot of influence on the global stage. So for me, I take the approach of absolute disruption, disintermediation, remove everybody and have insurance in the cloud. But the reality of the world and the way we're constructed is you have to sort of coexist with the traditional. And hopefully you can inspire others to start up, like all the other startups. Like, just keep going, because the more competition, the more success you'll have. So to answer your question, I have no idea what I'll be doing in 5 years' time. Hopefully next year I'll be here in person. I wouldn't cycle, it'd be on these roads. But.
What other pace of insurance companies going inside this blockchain story?
Oh, they're frightened to death. They're frightened because they don't understand. And of course, I work with them. Some of them are my clients, but there are some really enlightened individuals in the industry. But they're frightened to death because they don't know where to start. And the pace of change is so quick. They sort of rely upon regulatory barriers to sort of give them time to catch up. So they're still at education level, pilot testing. There's some great initiatives going on. I'm part of some of them. I contribute knowledge to others. But at the end of the day, it's a very slow-moving ship.
Ну, я правильно понимаю, что говорим мы о рынке страхования в Швейцарии и Лондоне, правильно я понимаю? Вы с этим рынком работаете?
If I'm right, we're talking about the insurance markets in Switzerland and London, right?
No, global actually. There's a United States effort, blockchain, the Risk Block Alliance. The European one is B3I, it's a nice one to follow. It's a blockchain-based. I have a great InsurTech network is big. I contribute to that. So there's an awful lot of, you call it grassroots movements. but collaboration is quite high for insurers and startups in comparison to fintech. And I think that's just nature of the industry, that we're sort of outwardly looking. We like to partner, it's a kind of a cultural thing in comparison to banking and insurance. It's lost its way a little bit, like sales, commission focused, but that there is a good core within the traditional industry that wants change for the future and a better world, which is what I'm contributing to.
I think culture here is the most important thing, because you are not likely to find somebody capable with dealing with this application somewhere in Africa, for example.
Well, actually, I would slightly disagree, because that's the emerging market is the opportunity, because they're going straight to digital. So in Europe and developed nations, we have a longer process, whereas in sub-Saharan Africa, there's some great projects going on. Just to shout out, like I'm not promoting them, but ones I follow, like Pineapple, peer-to-peer. Because in some ways, if you think about the construct of the economies, it's still quite mutualized in those developing nations, Southeast Asia. But when you overlay that with currency controls, and you overlay that with access to internet, access to digital, access to data, there's a whole digital revolution that has to take place for products, for new products, to reach those markets. But I see them as the biggest growth, because they're currently not buying much insurance because they can't get access to it. So we would, 5 years, we should be everywhere. But we take each day as it comes.